Ladies and gentlemen, welcome back. We're going to talk about private placement life insurance again today.
Yes.
In a more specific context. And that specific context is this concept that you see going around the internet called infinite banking. So what we want to talk about today is from a lawyer's perspective, does this work? How exactly does this play out? And is it or is it not legitimately something that you can do to finance your own businesses, your own projects, et cetera, without having to rely on a bank? So we're back once again with the inimitable Elizabeth Morgan. I don't remember what that means, but that's just a descriptor I chose. But we're going to explain this concept of infinite banking. So basically, to introduce this concept roughly, last time we talked about private placement life insurance. That's where you have a life insurance policy where you build up the cash value very quickly so that you can then borrow against it. And the reason you're borrowing against it is because you don't have to pay income tax on when you borrow against it, and you can continue to grow that money in either the separately managed account or whatever it is, but you can take that money and finance different things in your business or whatever it is.
Yeah, or your personal life, a vacation.
Or your personal life, yeah.
Yeah, exactly.
Yeah. You can go to Greece with it.
You can.
Yeah, and so infinite banking is a concept that you can just continually borrow against that and never have to go to a bank, right?
That's right. Well, and infinite banking has another concept built into it, right? So it's the idea that one generation starts it, they have the cash value, they can pull it out. There's death benefit that then adds to the pot, right? It becomes this family bank concept. So you're using insurance with death benefit and cash value to build this private family bank.
Okay, so explain to the viewer how the death benefit works in that context. How does the death benefit come into play? You're borrowing against the cash value, but the repayment is taken out of the death benefit, right?
Right, exactly. Well, two things can happen. Let's think about it. Step one, we buy a life insurance policy, and you and I in a second will talk about the different types generally. The life insurance policy has premium, cash that goes in. It grows income tax free. Then it's pulled out income tax-free if it's structured correctly. It's not a MAC, modified endowment contract. That cash can then be used as a lending vehicle to the family businesses, et cetera. There's an interest component based on the type of product inside the product. But the family also, if it's owning this in a trust or an LLC, and we can talk probably in a later video about how you would structure it, but there could also be a second interest component if you wanted to do that, so that not only is there interest inside of the insurance policy, but there's interest in the vehicle itself. So that's more of a family office discussion that we can talk about. But the infinite banking idea is that one generation commits to putting cash into these products. It's growing income tax free. It's supporting death benefit. And then as the insured dies, that death benefit stays in the structure, whatever the structure is, if it's a trust or it's an entity structure owned by a series of trusts. But the idea is it stays in the family. So it becomes infinite banking, and it's generational. Do
you just change the insured then? You just move it to the next generation?
Right. So let's say, I die, and so the policy's on my life. It comes in as cash, right? If there are policy loans, it gets paid off. And then that cash sits there. And the idea with infinite banking is whoever's in charge of the structure is supposed to now buy more policies on the lives of the next generation or, perhaps spouses, whatever. So it's a constant rolling set of life insurance contracts.
Hence the name Infinite.
Infinite. It doesn't ever go away.
Yeah. So, and what are the dangers here?
So
you exceed the cash value, you borrow too much against the cash value.
Yeah, you could borrow too much. Your costs in the policies are too high. So that kind of leads us to this, how do you structure the policy ownership, right? So you have whole life products, and I think we kind of talked about this in our last podcast, but a whole life product is one where the insurance company is responsible for the death benefit. So there's they take the premium, they go and invest it, they'll usually whole life products have a guarantee built in. So they'll guarantee a certain return, which makes them a really good foundational tool because it's very kind of sure, especially if you use a mutual company. Because then the mutual company doesn't have shareholders. It's owned by the policy owners. So assuming that the company is doing a good job investing, then they return the guaranteed amount plus additional amounts if they do well in the investments.
It's like a bond, sort of.
Kind of.
Where you get,
Like
guaranteed contractual return.
Exactly. So that's a whole life product. Those products are fantastic and foundational. The challenge is that when you borrow from them, most of those contracts, the borrowing rate is about what the crediting rate is. So if I borrow and my cost to borrow is 5%, but I'm being credited 5%, or that's my guarantee, then that means that I'm not making money in the policy.
What do you mean by being credited? So it gets credited...
So in a guaranteed product, or even in a whole life product, the product is making money, right? Because the company's investing the pooled account. You're being credited as a policy owner based on your contract. So the company will guarantee a certain return, just depending. And then there's an additional amount if the investments do well, but it's the company that's doing the investing, right?
The insurance company.
The insurance company. So my borrowing rate, if it's 4 or 5%, but I'm only making 4 or 5% on my cash, that means that I'm not making any additional money in the policy. Okay.
So you've just stalled the growth entirely.
Stalled it. Right.
Because you borrowed against it. But it might be fine because you wanted to use it as an investment vehicle anyways.
Right. But when you think about the way you're modeling the policy, you have to take that into account. Because as we discussed last time, the cost in those policies is based on the corridor. So if I've pulled the cash out, stalled the growth, right, then that means that eventually my cash is going to start to diminish, which increases the cost in the policy, and it could be a policy that, collapses. So that's a risk of those types of products. Coming from whole life, then you go into a variable contract. A variable contract has investments underneath, which is not unlike a whole life product, and they can have guarantees built in as well. It's much more retail, but the policy owner is responsible for picking the investments. So the risk there is that the policy owner does a terrible job. The question is, who do you think does a better job, the insurance company or the policy owner, picking mutual funds and investments that are going to work, right? Those products will have a borrowing rate that probably is about the same as a whole life product, but not quite as high because it's going to also credit you for, so in the policy there's a loan out and there's an asset. Same with the whole life product as well. It's just a question of how much are they crediting you on that note.
Does the borrowing rate always equal the crediting rate?
No, it doesn't.
Sometimes they're different.
Sometimes they're different.
Because the insurance company probably arbitrages a little bit between those rates.
Exactly. Yeah. So then when you get to private placement on the furthest side with the most cash, typically we see a borrowing rate of, let's say the borrower is paying 4.5%, and the crediting rate's 4%. That's a very typical amount in a private placement contract. The 50 basis points is really just what the company is charging to administer the loan. Right. So when you think about bookkeeping and all of that, so you think about that difference, you're not really stalling. You only have a 50 basis point difference. So your crediting rate is particularly high. So it's almost a wash. So when we're thinking about infinite banking, from my standpoint as a planning attorney, I want to make sure that I understand all of those dynamics, because when I have somebody who's actually going to borrow, out of the policy, I want to make sure I know what the economics are going to look like. And it's really important to model that or illustrate that at the beginning if you know that's what you're going to do. Right.
But 50 basis points is better than 6%.
6%.
Right? Which is what you'd have to get if you gotten if you just went to a regular bank and got a loan. So
right.
this really,
even in a whole life,
right,
situation. Now the other thing too is that you can go and have a collateral assignment of a policy and then get a kind of lower interest rate from a bank. So on top of being able to pull it out yourself, banks and lenders will lend on cash value in life insurance because it's cash value.
Mm-hmm.
So there's the infinite banking means that these types of assets are very bankable, or I don't know if lendable. Lendable is like a word.
Fungible?
No, I don't know. That banks will lend on these products because it's easy. It's easy to secure a lien.
Right.
It's
a box of cash.
Yeah. Well, if it's a variable contract, there's investments, but it's still, they know that there's liquidity. The insurance company is going to make sure it's liquid. So the basic concept behind the cash value, for if the viewer doesn't understand, is the cash value is the collateral for the insurance company that they're going to take if you stop paying your premiums on the policy, right? So the concept of getting a high cash value policy is you want to pour a bunch of cash in up front, because the whole point is you want to be able to borrow against it as quickly as possible. So you want to keep the fees down. You want to not pay your broker. You want to pay your broker not as little as possible, hopefully. Sorry, brokers. We love you.
But if you're from the borrower's perspective, you want to dump a bunch of cash in so you can borrow against it at basically no interest rate.
Right.
Which, like you just said, there's a little bit that a servicing fee basically that the insurance company
that the insurance
charges.
company will
like
charge.
50 basis points or something like that.
Exactly.
So, but how does that work if you pour a bunch of cash in initially? This is probably going to be a stupid question, but if you pour a bunch, let's say I put $3 million in first, and that's the cash value. I just put it in to borrow against it. Why didn't I just use the $3 million to go and do something with it?
Well, because this is a different asset class. So I'm putting money in. It's asset protected, right? So let's say that I'm in real estate development, right? If I'm holding it, I'm taking a risk that I could have a creditor who could come and take it from me, right? Some people are worried about the banking system, right? So is that the safest place to hold a bunch of cash? And again, we'll do a video on, too big to fail banks. And there's some, reason why people don't want to leave that much cash sitting in a bank account. So now the next question is, what do I do with it? Well, why don't I put it in a tax-advantaged vehicle? What are the options? I could do a retirement plan, like self-directed. I could do, a number of things. But insurance is just another bucket. So I put the cash in. That would be the cash that you're not going to need for a while, because there are actually some rules about how long it needs to be in there before you can start pulling it out. So, and it depends on the construction of the policy. So that money, the reason you're putting it there is it's asset protected, right? You've kind of in your own mind defined it as being in its own bucket. It then is going to grow on a tax-free basis, and it becomes kind of your future banking, not necessarily your today banking.
Mm-hmm. And as we discussed asset protection a little bit in previous podcasts, but the point is you're putting it in a legal box that's protected. So if there's a third-party creditor, or if there's a divorce, or if there's something like that, it's in a separate legal box. So if you had $3 million, you're thinking, man, I could just take that $3 million and go spend it directly.
Right.
But in this situation, you're putting it in something where it can grow tax-free. You can borrow against it tax-free.
Right.
And you can utilize that a lot better so that it continue to grow and then just turn into a much more generational asset that your kids can use and your future company can use, et cetera, et cetera.
Right. It's really a
So the concept is solid of infinite banking.
Yeah.
But it could be dangerous if you have the wrong policy, right?
Or policies, exactly.
Yeah, or policies, right, because sometimes they bundle a couple policies together to
right.
do the
And
same
the one
thing
that, I would say to the people who are listening, and seriously, this is nothing against insurance professionals, but if you think about it, the infinite banking concept is, convincing people to buy insurance over and over and over again, which is not in and of itself bad. It's just that you have to make sure that the policies are the right ones, that the brokers are looking out for your best interest, that you understand the commission structure and the way that the policies are being designed. And there are some really good folks out there who are, shout out to Steve Parisi at IBC Global. I mean, I think he does a good, woo! I think he does a good job. And there are other really good, honest folks out there. But I think the most important thing is if you're going to do infinite banking, it's not a one-trick pony. So now, you and I have talked to some of our clients who were only buying whole life. And as we were sitting there talking to them, it to me seemed clear that they needed to not do 3 whole life policies. They needed to do maybe 2, that's fine, and they needed a private placement policy as well.
Right.
So in that particular situation, the broker could only broker whole life. So when we came in saying we also think you should consider private placement, that was a hard conversation because the broker didn't want to lose that part of the business. Right? So I think that's...
The broker makes money in private placement too.
Well, they do, but it's a trail commission, and not all brokers can broker a variable contract.
Right.
So that's a different license.
Right.
So what I think, all of these things need to be done holistically, not just, it's not a one-trick pony, right? We need to have all of, infinite banking is a great idea, but we need to make sure that we match the product to the need, and we need various buckets. That's just, and it's not, domestic versus international or whole versus variable or universal. Really, what needs to be looked at is what are all the options, how many crayons are in the crayon box, and which ones do we need to, deploy in this particular situation.
Exactly. And first, one reason people are really attracted to this concept is, first of all, because they don't want to pay to borrow money, which is what you're doing with a bank. Right? So that's always appealing. The asset protection is appealing. But also, like you said earlier, there's this waning degree of faith in big banks and how they borrow and how they lend and how risky they are and how they just basically rely on the government to bail them out, et cetera, et cetera. So a lot of people, like in my generation, for example, are turning to something like Bitcoin where they can go borrow against their Bitcoin as a solid asset that's separated from this whole inflationary scheme and inflationary environment. So regardless of how you feel about fiat currency, et cetera, this concept has been around for a very long time. This is something that you can separate yourself entirely from the loan and credit system that exists in kind of centralized banking system and just do this on your own. That's why it's very appealing for a lot of business owners because they don't have to deal with bringing in creditors onto their business. They can just borrow against their policy.
Exactly. And I think that that's a trend that we've been seeing for a while, and I think it'll just continue. I mean, unfortunately, our institutions have felt shaky, and so people are looking for ways to not have to rely on those institutions. Now, the thing about infinite banking, you have to, it's a plan, and you have to start it, and you have to follow it, and
there's administration involved.
And you have to have a lot of foresight to do that. So it's I
guess the conceptual way to think about it, the picture to think about it would be infinite banking is you being your own bank. If you're going to be your own bank, banks have expenses. You got to pay your employees. You got to pay your tellers, whatever they call it. Tellers. And so in the same way, with an infinite banking concept, there are expenses that are continual that you'll have to keep paying to keep the policy up to date and keep it clean and keep it so that it actually makes sense to continually borrow against your policy.
Right. And if you think about it, the challenge to that is the death benefit can get pretty high. And the thing that people need to realize is if I own an insurance policy, that death benefit is attributed to me. Right. So it's not out of my estate for estate tax purposes, even though it's out of my estate for income tax purposes. So now the next question is, how do you structure that? Is it in a family trust? in which case you might need an outside administrator because I can't control anything having to do with a policy on my life without causing it to come back into my estate for estate tax purposes.
Right.
So the structuring of those has the business aspect, it has the income tax aspect, and it also has the estate and gift tax aspect.
That's such a good point, and I think that this is something that obviously I'm really glad you brought that up because we work a lot with the estate tax planning and doing tax planning generationally. But a lot of people get into the infinite banking concept because it sounds so appealing, but they don't realize that if they own the policy, you have something called incidence of ownership, then that death benefit could be huge. Could be $20 million, could be $40 million, could be a massive death benefit.
Right.
That comes into your estate after you die. And if it comes into your estate, and you haven't done any planning for it, then the government's going to take 40% of it.
Exactly.
So that's the kind of thing we like to avoid too. And that's the kind of extra layer of planning that we put onto the policies that we do with our clients and the planning we do with our clients. If we set up a irrevocable life insurance trust or whatever it is, we add that on because that's a consideration. We don't really want to see all the work you put into the policy and all the stuff you built your business with have 40% of that go to the government.
Right. And there are all kinds of, interesting things you can do. Infinite banking tends to be kind of more plain vanilla. We're going to do this for the banking purpose. But there are all kinds of other ways you can do it, arbitrage transactions where you could borrow from a bank to then put the cash in the policy. If the borrowing rate is smaller than the crediting rate inside the policy, then you've arbitraged those dollars and you're good. You could also lend money from, one trust, let's say a completed gift trust that perhaps you control, so you couldn't really buy it in that particular trust. You could lend money to a new trust that works depending on the planning that you're addressing. So and the thing that you have to be careful of, you don't want any transfer for value. If you're trying to move policies around,
because taxable.
We don't want to have that income taxable. So,
this is getting advanced.
Stop. Well,
arbitraging life insurance policies in and out of trust.
Well, when we're talking about infinite banking, there's that piece of it, the choice of product, the choice of broker, the choice of structure. And then how are we going to finance it? So all of those things, and then what are the tax consequences of the financing modality that we've chosen? So when you think about it in kind of your Venn diagram, that's kind of what it looks like. And all pieces of that, I think you and I are going to talk about in future videos.
Yeah.
So.
Yes. So to summarize really quickly, infinite banking is a good concept that we endorse, provided that you have the right policy. Provided that it makes sense for you specifically, whatever your business is, whatever your life insurance situation is, because all that actuarial stuff comes into play too.
Right.
So it does work, and it's like Elizabeth likes to say, it's another crayon in your crayon box. It's another.
I love the crayon.
It's not my favorite analogy.
I love that analogy.
It just makes me think of like a little kid drawing a picture for the fridge. So it's another tool that you can use, definitely, and a lot of our clients do use it, and so it's something that we definitely recommend and put in your toolbox as a business person and entrepreneur.
We've gone from crayons to tools. I just wanted to say we've mixed the metaphor.
Well, crayons are tools,
Okay, that's probably true.
For some people.
For
some little people. So. Yes, infinite banking is a great concept. Elizabeth already mentioned IBC Global. We work with Steve Parisi a lot and his company that has a fantastic broker of these policies. We also set up policies. We do private placement life insurance. We do irrevocable.
We have a really good broker.
Trusts.
Yeah, really good
broker. Great broker. And if you're interested in this concept, do it right. And it's really helpful to have someone like our team on board because we know what we're doing. Elizabeth has set up lots of these policies for a lot of very high net worth people. She's seen how they work, how they when they don't go so well. and what the dangers and pitfalls in administration and all this stuff is.
Right.
It's a tremendous asset. We recommend it for basically all of our clients, but it just has to be set up correctly. So it's going to be a link to our website in the description. You can contact us if you're interested in this and get one of these policies set up, and we'd love to work with you. So
yeah, thanks.
That's
Have
going
a
to do
good
it for this one.
Yep. See ya.
Thanks, everybody.
Bye.